Let's get in Gurmeet Chadha, co-founder and CEO, Complete Circle Consultants, who's with us on the show as well to chat about the market outlook. Gurmeet, great to have you on board. Let's talk a little bit about how you've read into both the IT majors in terms of the kind of results that they have delivered. What's the pecking order now?
Interesting set of numbers, and if you see, I think it was broadly the same. We saw TCS posting about a little less than 2% revenue growth in constant currency terms, Infi a tad higher, and we saw the margin compression with TCS coming in at around 25% and Infi at 22.6. I think what was heartening to me was three things. I think the traditional verticals for both, which is BFSI, which is a third of the revenue, grew. It grew higher for Infosys vis-a-vis TCS. The utilities did well. The digital business, obviously again did well. TCS was a little better off. More importantly, the deal momentum was good. Both the IT majors had a good deal momentum and announcing some more client wins. And Infosys in particular, probably now, I think my sense is with the revenue guidance they have given, the valuation gap it had with TCS, could slightly bridge. It was almost at a 20% discount. Now with TCS correcting and Infi, in all likelihood doing a little better, that gap should over a period of time shrink. So I'm not too bearish on IT. One thing one has to watch out is that the mid-cap IT names could be under pressure because we have seen the margin pressure largely on account of twofold. One is the supply crunch and increase in cost both on-site and off-site. So the mid-cap IT names one has to be a little careful in picking.
Gurmeet, what do you do with DMart now? The numbers have not been impressive and the valuations haven't in any case justified even when there was, intact growth. But do you sense that we could see some further derating in the stock? I mean, it's already down 10.5%. It's sub 1400 already.
Yeah, Aisha, I think possible. We've seen that if you don't buy growth at a reasonable price, some of the fancied names have come under pressure. We saw that with Page Industries, we saw that with Eicher, and now with this is the second quarter where DMart saw margin compression. In fact, if you see if you do the breakup, I think they were largely on account of two factors. One was obviously the price reduction because the management wants to give the maximum value for money to the retail customers. Second was also the higher interest cost because of the NCDs and all which they have been issuing. So I don't see the trend immediately reversing. So somebody who's a long-term investor, it might be a sensible strategy to wait it out, let it find a good level. It is a good, if you have to play the Indian retail story, it is one of the top picks there. But I think it's still pricey. So one has to probably just wait for it to consolidate a bit and then maybe use the dips to accumulate.
Gurmeet, what is your expectation from FMCG largely and staples in particular? You've got Unilever reporting its numbers just this week. While 2018 has turned out to be a solid quarter across the board, there was also that low base effect which was favouring most FMCG players. Do you think this quarter onwards we're likely to see some genuine underlying demand actually take an upturn, or would it continue to be the low base effect which will push them through?
Aisha, I'm positive on FMCG despite valuations being stretched, primarily because of three factors. A, you will see as we get into an election year, you will see heightened spending, especially the rural-focused spending. There are already talks of farm income going up, some universal basic income coming through. Every election in India is like a mini QE. We see a lot of liquidity getting created, and typically it's pretty positive. Also, I think that we are seeing volume growth. So if you see Dabur numbers, which been a bit of a laggard, we saw 8% volume growth for Dabur as well. Lever obviously had and double digit. Also in India, while the FMCG, the entry barriers are very high. Just to give you an example, a Lever which doesn't really talk about the distribution strength has about 10 million outlets. That's a staggering distribution reach for anybody else to, imitate and get into. We saw Patanjali initially giving threat, but, now even those numbers seem to be coming off. And ones who makes a first mover advantage in spaces like FMCG in India, tends to stay. So if you see China, Unilever hasn't been able to beat P&G despite all the effort. here, because in India they came early, they have a better reach, they are doing much better. So this distribution reach is often very understated. Second, I think the commodity prices will remain soft. Both food and non-food. If you see the WPI numbers, they're clearly showing the trend, which could aid margins. So volume growth, a slightly better margin profile augurs well for FMCG.
What are you hoping to hear, Gurmeet, from Reliance, even though the numbers will only be on Friday post-market hours and we'll get a reaction only on Monday? But do you think that could turn out a little disappointing, or would it be at par?
So I think it's in the price. You may not see a lot of incremental, positive news flows on the as far as Reliance is concerned. I think what would be interesting to see would be the gross refining margins. With the kind of fluctuation you have seen in crude, chances of inventory losses are higher, but all depends on how adept they are in handling that. And if you see Reliance, traditionally the gross refining margins are 400 to 500 basis points higher than the Singapore benchmark. So that's a standout for them. Also, I would be interested to see the Jio numbers. There were news of it crossing 400 million subscribers. Would be interesting to see the ARPU if there is any improvement there. And I personally think that Reliance is a good play on data and content. India, we have very limited play on content. We saw Netflix releasing a series called Bird Spot last week, and it had 45 million views, which probably were more than the live sales of Harry Potter series. So we have generally no proper content play in India, as far as the listed space is concerned. And Reliance possibly could fit that bill, but it's a more long-term call, not immediately from the result perspective.
Correct. The numbers are going to be on Thursday post-market hours, not Friday.
Gurmeet, I'm just going through your note, and you mentioned that dollar liquidity is shrinking, FIs are pulling out money, you're expecting global growth to slow down, you are anticipating mixed earnings, you're also saying that commodity prices would be softer. But one positive statement which caught my attention is that you are seeing visible growth in certain pockets. Now, one of the pockets which you mentioned is FMCG. Which are the other pockets, irrespective of sector, where you are seeing growth taking place, irrespective the global backdrop which you are painting a bit red?
So Siddharth, basically, just to name a few, one is the niche financial space. For example, the life insurance vertical. Our topic is HDFC Life and SBI Life. HDFC Life in particular, if you see the new business premium is growing at 22%, which is the highest in the industry. Their ROEV, which we called as return on enterprise value, is again at about 22%, which is again top notch. Leader in credit protect, their protection business also is almost 11% of the APE. And they have done some amazing bank insurance tie-up. It was about 5 years back, 65% of the premium used to come from HDFC Bank. Now it's about 50%, and they've done some more than 100 bank insurance tie-ups, which include 25 banks, about 70 odd NBFCs, and few microfinance. So that's a huge distribution reach. And as a country, we do not have any social security net. So life insurance, asset management business, that was the second pick in that space, looks very, very good. Mutual funds, again, growing 20%, year on year. Every 3 years, 4 years, the AUMs are doubling with this financialization of savings playing on. So niche financials is one. I also like, some plays where we have seen a good price correction, and where, softer commodity prices can translate into, and with better pricing can translate into material gains. I like Page Industries at these levels. One can possibly, try and accumulate. And this is a space where the market will see a secular growth. It's a $5 billion industry right now, the innerwear, where men innerwear is about $1.5 billion and women innerwear is $3.5 billion. The industry is growing very, very fast. Apart from Jockey, Page has done tie-ups with Speedo, which is into swimwear. There is a lot of focus on kids innerwear and terry towels, which is again, a niche place to be in. And we can see good volume growth along with very, very high margin, because this is a premiumization story. So these are the two picks from my end.
In fact, let's just quickly take a look as to which are the stocks that are buzzing away in today's trading session. And on the downside, the names like Dish TV, Tata Sponge, Wipro, Zensar Tech, a lot of those mid-cap IT names as well continue to take it in the chin, while the likes of Graha Finance, Jain Irrigation, as well as Manappuram Finance continue to look quite bleak in trade. Gurmeet, let's get in a take as to what exactly your outlook is on the metal space as a whole. Would it be a complete avoid on the back of concerns with respect to pricing, the overall global headwinds?
So largely avoid, reason being that, it's very cyclical. And, as I pointed out, if you see, Fed is tightening almost, if you see $200 billion every 4 months, that almost tantamounts to a rate hike every quarter, even if they don't do a, rate hike. We saw China export numbers for December being very, very abysmally low. I think in auto, for example, for the first 20 years, China for the first year degrew. Slowdown in global growth, China slowing down, and China is 50% commodities. It doesn't look to be a very, very happy space to be in. Also, some of the Indian names, they've taken debt at the very wrong stage of the cycle. And I haven't done enough deleveraging for me to give comfort on a long-term basis on earnings. So would we avoid? There could be some select pays, you can do which are high dividend yielding, like a Coal India. There could be a Hindustan Zinc. So there will be some tactical plays, but you can't take right now a fundamental call. And it's best to avoid, especially if the macros are looking weak.
These companies, in fact, Coal India recently made an all-time low. One can argue that it's a high dividend-paying company, but then the way things are getting handled from the largest shareholder, there are a lot of skeptics, and that's the reason stocks like Coal India and others are trading at multi-year lows or so. Gurmeet, thank you so much for joining us and sharing your insights on markets and a host of sectors which you spoke, and some of the stock names which you suggest to our viewers to invest from long-term perspective. Great having you.